have the pleasure to have with us distinguished panelists that I will introduce shortly to discuss about the future of Greek banking. The future in a very dynamic, I think you will agree all, environment that we live in. One of the most known bankers worldwide of Greek actually origin, Jamie Dimon, once said that you are not allowed to assume that the business cycle will not turn. In fact, you should assume that every 5-6 years or so, something bad will happen that will affect banks as well. And we have been here last year thinking that this bad thing that could happen once in 6-7 years has already happened. In fact, there are things that happen that were once in a generation or even less frequent events. But here we are today, experiencing still a brutal war in our neighborhood, and experiencing an energy crisis that followed the Russian invasion. Still, within this period, Greek banks performed remarkably well, and actually over the last year they have improved their performance. So we will be discussing with our distinguished panelists on what lies ahead, what is ahead of us in terms of future of the Greek banking. And we will combine both internal perspectives from senior leaders of Greek banks and external perspectives. So we have the honor to have today in the panel as panelists the chairman of the National Bank of Greece, Mr. Gikas Hardouvelis. We have the chairman of Eurobank, Mr. Georgios Zanias. And we have the general manager and CFO of Alpha Bank, Mr. Lazaros Papagaryfallou. We also have the honor to have with us from external perspectives, if you will, Ms. Elizabeth McCaul from the Supervisory Board of European Central Bank, Mr. This is a French name, so it's not easy for me, Jean-Sebastien Dietsch from the Financial Institution Coverage Group of BNP Paribas, and Mr. Euan Robertson, a partner at Oliver Wyman. So let me start the discussion top-down with the wider macroeconomic environment in which Greek banks will have to operate over the next couple of years. And Mr. Gikas, could you share, as we open our panel discussion, your view on the macro outlook for Greece the next couple of years, and what you think that this outlook could imply for Greek banks as we see ahead?
Thank you, George. I think we heard during lunch a lot of discussion about the macro outlook. It's true that the next year is characterized by a lot of geopolitical uncertainty and issues like energy security. But the key variable to watch is inflation. Now, if you asked me a year ago, what do I think about inflation, I would say, as long as the war continues, it's hard to predict. Inflation is going to stay. But I think we have seen the peak of inflation, at least for on commodity prices. And I think inflation is going to come down in 2023. In Greece, for example, right now we have inflation rates of about 9%, and we expect in 2023 the average inflation to be approximately 4.5%, 5%. So inflation is coming down, and monetary policy will continue being restrictive. It was restrictive in the past year, and it will continue doing so, I think, until the first quarter of 2023. I expect the Fed to continue jacking up its policy tool, the Fed funds rate, perhaps to 5%, and the ECB also increasing its own policy tool to about 3%. So so monetary policy is restrictive. This is very different than the crisis of COVID. Back then, monetary policy was lax. Fiscal policy was lax. Today, we face a very different macro environment. Even fiscal policy is very constrained. It doesn't have the degrees of freedom it had before, primarily because exactly due to COVID, countries spend a lot of money, the debt levels have gone up, so governments now are trying to sort of find ways to rein on their deficits. Now, what this implies, of course, is something we all know, is that interest rates are rising, but in my view, this is not particularly worrisome. And why do I say that? I think the increase in interest rates we observe is back to normal. What we observed over the last decade, the very low nominal interest rates, the even negative interest rates, was an aberration in my view. I belong to the baby boom generation. I did observe what happened in the 1970s and 1980s with inflation. So I don't want it to be repeated. I always felt nervous about the previous environment. Now I feel we're back to normal. I think now the right incentives are in the financial sector for risk and reward. So I think, it's less likely that we see stock market bubbles. It's less likely we see real estate bubbles. Rates are more normal. Now, for next year, of course, the big issue is real GDP in most countries will be close to zero. Some countries will have negative growth. In Europe, the same story as in the US. Greece is slightly different. You heard this over lunch. Greece, this year is growing about 6%, and next year it will keep growing. The official forecast is 1.8%. I think most analysts agree that we're going to attain that. And why is that? I think the primary reason is that the Greek economy is very resilient exactly because it went through a huge crisis, domestic crisis before COVID, and this has left the private sector very strong. There was a lot of restructuring that took place. Right now, the private sector is not over-indebted. There's a very low leverage ratio, a lot of liquidity. So we're dealing with strong fundamentals. In fact, if I looked at a survey that NBG does the past 14 years on every 6 months on SMEs, and I was amazed to see that for the first time, 86% of SMEs have huge investment plans for the next 5 years. In fact, the attitude has changed among the small companies. Now small companies actually want to cooperate with each other. They're looking to expand. 2 out of 3 companies are actually looking to cooperate, whereas 5 years ago, only 1 out of 3 was behaving like this. So there's something definitely more healthy about the corporate sector in Greece. Now, what about all these macro developments? What do they mean about the banking sector? Of course, banks go up and down together with the economy. So if next year is a tough year, as we heard, will this be tough for banks? The answer is yes and no. I mean, the demand for credit, we believe, will continue growing, but it will grow at a smaller rate. Of course, there is worry that some people may not be able to pay back their loans since installments are rising. In Greece, loans are almost 100% on variable rate loans, so installments are going up. And this affects primarily households, not so much, the companies are affected, but they don't mind as much. Households have a problem because also their personal income, the real personal income is declining at a time of high inflation. Now, of course, there are countervailing forces like unemployment is declining, there's jobs growth, wages are rising, so these are countervailing forces, yet households will have a problem next year. Now, what about banks themselves? I mean, the banks sort of just finished with the baggage of the past. Their NPEs have declined to single digits. They have a lot of capital. They do have a lot of liquidity. If you look at the ratio of loans to deposits in Greece, it's only 60%, whereas the average in Europe is over 100%. So there's a lot of cash lying around, and the banks do have the means to actually lend to the private sector. The question is whether there's demand out there. There was a change in the last 3 years. A lot of money actually entered the economy. At least 12 billion euros of net new lending took place. When I say net new lending, it's total lending minus the repayment. So there's a lot of money given out. In the last 9 months, for example, the growth rate in business loans was 12.5%. This was higher than the growth rate in Europe, and we haven't seen this statistic since 2007 or 2008, I believe. It's long before. So there is a lot of money going around. There is also the recovery fund which provides a safety cushion to the private sector. And banks actually do compete, and they provide new lending at very competitive terms to their customers. I guess the panel will discuss this. Banks are doing better nowadays. They are trying to compete with fintechs and big techs. They're actually in collaboration with lots of them. They are revamping their IT systems. They invest a lot in IT development. And in general, they follow, I mean, there's a big drastic change that happened in the banking system over the last 10 years, which is they follow best practices when it comes to corporate governance. And in their long-term strategy, all of them have adopted a customer-centric strategy, which is the customer first, and how are we going to service him better. So I'm optimistic that banks will continue lending. They will support Greece become more competitive and therefore more productive. And I hope, since we're in an investment conference, that we will see it perhaps next year. Prices will probably pick up the moment investors realize how healthy banks are. Right now, the price-to-book ratio for banks are like 0.4, 0.5. I expect to see an increase next year. This is my prediction, and thank you.
Thank you very much, Mr. Hardouvelis. And moving on, Mr. Zanias, to you. I mean, within this macro environment that Mr. Hardouvelis described, where do you see most opportunities in terms of credit expansion for the Greek banks, and any particular sectors that you believe will be more lucrative, and why?
Thank you, Mr. Papagaryfallou. I will start by saying that I have been attending this Capital Link conference for many years, and it is the first year, I think, that we can safely say that the Greek banks are out of the woods now. We used to have, as Gikas also said, a very high NPE ratio. Now it's less than 8%, but even this 8% is really inflated because the denominator is small. Only 60% of GDP are the loans which form the denominator. And as you asked, and as Gikas said, also Greece is entering a new phase of growth during the past 2 years. Just think, Greek economy grew by 14%. 14%, 8.5%, and maybe 5.5%, or whatever. Now, these are huge, really, growth rates, and for next year again, we're going to be positive, whereas most of our peers in Europe are going to be negative. Now, banks are expected to play a very important role, really, in financing growth alongside the RRF, as the country is a bank-based economy, really. Now, the Greek banking sector not only is capable of providing the necessary finance for this growth, but it can also direct capital to its more productive uses, because this is the job of the banks to evaluate projects and finance the sustainable ones. And hopefully, together with the RRF, we're going to finance the ones that lead to sustainable growth, also growth that's based on investment and exports rather than a growth that's based on consumption as it was before the crisis, and you saw all these results. So for all these reasons, in 2022, I think Gikas also touched upon this, we're going to have net credit expansion, Gikas defined net credit expansion, which is double digit. The thing is that this is coming mainly in the business sector, which means that credit expansion in the business sector is more than 15% really. These are huge numbers for the first time in Greece after many years, really. In Eurobank, we made a study about the sectors where finance will be directed. We identified 5 sectors, really. These sectors, I've written them somewhere. It is energy, of course, telecommunications and digitalization, infrastructure, tourism and real estate development, and industry, of course. Industry is coming back. Now, it's very, there are 2 things about this. About 38 billion of investment during the next 3 years will go to these sectors. These investments and this financing is very necessary because we have an investment gap in Greece, a very serious investment gap, and only until very recently, last year or the year before, gross investment were lower than depreciation. We had a negative net capital expansion, really. There is also a qualitative change because compared to the high investment rates that we had in the past, now, as you see from these sectors, these are more productive sectors than the construction investments that used to take place, and this is the main gap, really, before the crisis. Eurobank finances a significant part of these investments. This year, about almost 3 billion of net financing, and credit expansion we estimate between 20 and 25, 2020-25, will be about 86% in Eurobank in the corporate sector. I'm sure that similar figures exist also for the other banks, as you saw only in 2022 in the business sector we have about 15 or more percent. So now, you see, the thing is, despite this expansion, there is something that we are lagging behind, because most of that is coming from the business sector, first of all, and second, the loans in Greece are only 60% of GDP. Before the crisis, we were more than 100% of GDP, where even today, similar countries like Portugal have more than 100% of GDP. So there is a long way for Greece, really, to proceed. The other thing is, I was comparing the figures between Greece and Portugal, and I saw that the corporate sector in Greece and in Portugal, they have about the same volume of corporate loans. But the corporate loans in the household sector, that is mortgages and consumer loans, are 3 times higher. So really the scope here is, apart from the business sector, really to mobilize the household sector. There is a very great scope there for Greece. Now, a number of reasons really exist that keep the household demand for loans low. One thing, of course, is that, as you know, Greece lost 1/3 of its income during the crisis. The households became poorer. Additional uncertainty was injected into the system because of successive crises after that, and uncertainty, and both these factors, uncertainty and lower incomes, are very strong factors against higher demand. Many potential customers are blacklisted in the credit bureau because there are so many loans that are not being serviced. And another thing is that there is we do give mortgages, a lot of mortgages to give, but you see, if we're talking here about net credit expansion, which subtracts the ones that are being repaid. And 20 years ago, huge numbers of mortgages were given that are now expiring. So we have this problem also to face, but gradually we will pick up. Now, about one thing is that there are a lot of loans at the services. This is another potential source, really, for loans to return to the banking sector. The services estimate that about 20% of their loans will return during the next 3 to 4 years. This will add about 10-12 billion to the existing number of loans. Then after that, the process will be more slow, really, as growth proceeds and restructuring of these loans takes place, that the population to which the banks lend money will increase. So another factor that will be important also is that the Greek businesses have to attract also some equity. The Greek business sector is over-leveraged, as households also are. And by attracting equity, which is a weak point in the Greek economy, makes also lending easier. So, as you see, there is a great potential in front of us. And let me conclude by saying that no one wants more than the banks to give loans, because this is our job. The point is to avoid mistakes of the past. And so we take it very easily and very, very seriously, being very careful. Thank you very much.
Thank you. And turning to Mr. Papagaryfallou, over the last years there has been extensive transformation in the Greek banking system, covering from digitalization, asset quality, culture, people, and many different other angles that I mentioned. So how wide is in substance this transformation that has happened in the Greek banks, and what really lies ahead of us now from where we are now?
Thank you, George, and a warm welcome to everyone who is watching us. The term transformation has been used widely in the last few years in Greece to describe narrow or broad approaches to change. In Alpha Bank, we see transformation as a top-to-bottom change in the mentality and a way to do business. Let me use a metaphor to illustrate the case, at least for Alpha. Think of a holistic retraining of a former champion who wants to become again a star athlete and compete at a global basis. You start with the diagnosis so that you understand the situation of the athlete in the current juncture. Then it's about setting realistic targets so that the athlete focuses on the short term. For us, this has been the setting of a new strategy. Then you put together a team of same-minded people to lead the rehabilitation of the athlete. And when you have these ingredients in place, then you start dealing with the injury. In the case of Greek banks, this injury has been dealing with the legacies of non-performing exposures. As it happens in every injury, you also need to rebuild muscles and strength. In the case of Greek banks, this relates to organic capital generation, releveraging of the balance sheets, and attraction of talent. And then you also need to take care of the fat that has accumulated during the inactivity period. And for us, this was about dealing with costs. And as you have all these physical ingredients in place, then you start improving your lap times and the performance, which in our case means getting back to profitability, so making the shareholders happier, and caring about customer experience, making customers happier. But let me give a few milestones in this journey to make it more tangible. It was about survival mode, which led us to develop a strategic plan, which we presented back in 2019. Then you need to remember that this bank, at least Alpha Bank, was run by a family for many years. So a new CEO was elected in 2019, and this CEO, he brought together his new executive committee, a combination of outsiders and insiders to lead the effort. The focus was predominantly on managing non-performing exposures. So we started back in 2019 with a 44% NPE ratio, and we reported an 8% NPE ratio in June 2022 through a combination of jumbo securitizations and outright sales. We also had to break down the bank in two pieces, a good bank and a bad bank, to make the project operational. Then we had to relever the balance sheet. The Greek crisis has resulted in the shrinking of the balance sheets of Greek banks. So in 2019, we had performing loans of 27 billion euro. And during the pandemic, we have managed to increase our loan books and give money to the economy, despite the challenges, increasing our performing loans to 31 billion euro as of September 2022. Then the Greek crisis had also resulted in a brain drain, and the government has focused a lot on making sure that there is repatriation of talent. So we have capitalized on this opportunity to repatriate talent, and we have repatriated almost 50 executives for middle and senior management positions. We call them Ithakans. Then we have also re-engaged with our employees after many years into renewed performance dialogues in order to identify and reward excellence. We have launched academies to make sure that new skills are blended with old skills. And from the coming quarter, next quarter, we are launching dual career development programs so that both managers with managerial responsibility and specialists develop themselves within the bank. We have also introduced diversity in our agenda, promoting female empowerment programs and engaging in other relevant activities. Coming to the operating model, in retail we have shifted from a product approach to a segment approach, tailoring our offering to segments with quite a significant success. When it comes to sales, fulfillment, it has been traditionally happening through the branches. This is still the case, but we're gradually shifting sales to digital channels. Take, for example, a new consumer loan we launched earlier in 2022. 70% of the sales are happening digital only. Coming to credit decisioning in retail, we have automated the credit decisioning engine, and this has resulted in more than 50% of disbursements in retail happening without manual intervention. In wholesale, the focus has been on increasing the productivity of relationship managers, taking out administrative tasks so that they focus more on managing the client. With regards to our IT operating model, we have changed the structure We have introduced Agile and DevOps, having increased significantly the efficiency to deliver the output by almost 20 to 30% in terms of output. When it comes to back offices, we have shifted mentality from managing the troops to managing special forces so that they focus on automation and the improvement in processes. From a job for life approach, we are encouraging innovation so that we improve ourselves for our customers. And lastly, from big losses that we have been encountering the last few years, we shifted to profits, and we are well in the trajectory of reaching a 10% return on equity, which was the financial target we presented back in 2019. And some thoughts at the end of this speech. Transformation is not just about delivering projects and tasks. It's about having this mentality to challenge yourself and change. At Alpha Bank, the big merit of engaging into such a process is that we now know what it takes to transform, and we can now conceptualize, design, and execute next steps. So it's also about the journey, which has been a pleasure for us and a big gain out of this process.
Thank you very much, Mr. Papagaryfallou, and I liked very much this analogy about the athlete. And I will use this analogy for my first question to Ms. McCaul, as we now will couple on a reality check the internal perspectives with external perspectives. So Ms. McCaul, Mr. Papagaryfallou described an injured athlete who recovered, who built muscle, who built strength, who now has increased his lap time and is in a much better shape. But how do you, from a supervisory perspective, view this progress of the banks over the last years? And most importantly, has the athlete now built the strength and the muscle to justify, after more than a decade without dividends for the investor of Greek banks, is he strong enough now to, from a supervisory perspective, to justify a dividend payout?
I think this athlete has done a lot of physical therapy, a great deal, and very successfully. Let me say that in that way. So the program has been followed, that's for sure. It's not the case that everyone follows the physical therapy program, but in this case it has been. Just to give you an idea of the magnitude of the physical therapy, the NPL ratio stood at 49.1% in June of 2017, and it's been reduced to 10% in June of 2022. And that's a massive balance sheet cleanup. And it also, very interestingly, materially accelerated in 2021. And that's in spite of pandemic, since 2021, it's been accelerating. In spite of the pandemic, in spite of the war. And that cleanup's been possible thanks mostly to the NPE securitizations, and those were executed, of course, with the support of the Hercules Asset Protection Program. So now the NPE loans are largely outside of the banking system. They're under the management of the servicers in charge of implementing the business plans. Then those business plans are embedded in the securitizations on an overall basis. So that's a good thing on the one hand, but I also noticed that Mr. Zanias mentioned that the loans are not gone from the economy. They're still there, and it's going to be very necessary to continue to be quite focused on making sure that those loans don't come back on the balance sheets of the banks in some way, either indirectly or through some interconnectedness. So we want to make sure we keep an eye very much on that. So thanks to all of this cleanup, asset quality has improved significantly, and there were severe losses that were reported in 2021, and that's associated with the de-risking process. It costs money to do that, but banks are now in the process of building higher capital buffers, and that's also thanks to the current profitability, because the macroeconomic environment has obviously changed with interest rates. So let me say a few words just about capital planning, and I want to speak first generally. We have, as ECB, and given the geopolitical picture and the macroeconomic environment in which we are living in, we've requested all of our banks to provide their updated financial projections to us and to give us their underlying macroeconomic assumptions. That's in the context of an ad hoc data collection exercise, and we've asked to have that information by the end of October. This exercise will allow us as supervisors to really have our thumb on the pulse of what's happening. We want to be able to assess banks' adequate planning to ensure that they have sound, adequate capital planning processes and that those are being done on a forward-looking basis. That will allow us also to assess management actions in response to the crisis and also to assess their distribution plans, to your question. So we are going to keep on monitoring the quality of the bank's capital. We're also going to be looking at their financial plans. We're also looking for, and this is with your athlete, looking for agility in being able to update plans as circumstances change. If there's one thing we can say about this last year, it's been full of surprises and full of risk in the system. So the agility is going to be quite important. We have no plans to introduce any general blanket dividend recommendations. We're going to continue to do what we've always done, which is assess on a bank-by-bank basis the distribution plans. We are expecting those distribution plans to be very much anchored to the capital planning process, to have sound macroeconomic assumptions, to have severe adverse scenarios and baseline scenarios that are practical and that make sense and that they're being done on a forward-looking basis. We're also indicating that any distribution plans, and again I'm speaking generally about the entire system, that those plans have to be subject to the fulfillment of the strategic plans, so that the banks have put in place strategic plans. Are they executing on those strategic plans? And that has to do with the profit generation as well as the quality of the capital and the capital trajectory. What kind of headroom is there? Now, with the Greek banks in particular, of course, capital remains very much a focal point for us and takes a lot of our supervisory attention. We already noted the extraordinary cleanup that's there, and there were significant losses in 2021 that's impacted the level of own funds in the institutions of most of the banks, leaving them with limited managerial buffers. And so, in spite of our concerns about the high DTC ratio, in 2022, capital ratios are progressively increasing, and that's on the back of the P&L improvements that are happening. There's been an overperformance in the P&L area, and that's positive, but there's still some way to go. So regarding the possibility of banks to distribute, let me just say that that decision is going to only be taken after we have a very clear view of the 2022 performance. We also need to be informed by an associated 3-year capital plan. And as I said, we will be assessing the updated scenarios. The scenarios out there have been changing quite rapidly, back to my agility comment. And we're also going to be looking carefully at the available buffers. We think it's very important, and you talked about this, Lazaros, about the sustainability of the business models and the organic capital generation. We're going to be paying very close attention to the capacity to generate adequate and recurring profits over time in a sustainable way. We are very interested in the fact that a number of banks have embarked on transformation plans. This is a good thing. The digitalization efforts are a good thing. These innovation opportunities and the management of the related risks are really at the heart of how we are analyzing some of these things, and we're encouraged by what we've been seeing. So in 2022, the banks are experiencing positive profitability. That's been sustained by the higher margins on the top line of the P&L, and that's been allowing the banks to increase the capital reserve and their retained earnings, and we're definitely welcoming this athlete's recovery and the positive trend that we're seeing, and we expect on an ongoing basis to see compliance with P2G. We want to see sustainability of the P2G, stability of the P2G, and we also want to make sure that higher managerial buffers are also restored.
Thank you very much, Ms. McCaul. And maybe changing a bit the lens now from the supervisory lens to the foreign investor lens, Mr. Dietsch. I mean, based on your work, you do interact a lot with foreign investors. So I'm really interested on what is your perspective, understanding on how they view currently Greek banks, foreign investors' view on our Greek banks.
Thank you very much. First of all, one thing we could say is that this is actually quite a good moment for investors to look at banks, and there is a very strong catalyst, which is the the rise in interest rates. And if you look at the first 2 months of this year, prior to the Ukraine war, all the banks in Europe re-rated massively on the stock market just because of this interest rates momentum. And of course, Greece is part of it. And if you look at the EPS growth prospects from our analyst at BNP Paribas Exane, which is one of the leading research house for banks, this is double digit for good reason. So it's a favorable environment. Now, if you look at Greek banks, what happened again this year is an outperformance in the stock market versus peers, and this outperformance is very much driven by the reduction of the cost of capital. And reduction of cost of capital is the effect of normalization for all the reasons that were explained on this panel. Normalization of the banks thanks to reducing the reduction of the cost of risk, the kind of not yet investment grade, but on the way to becoming an investment grade country, and much improved capital ratio. So clearly, when you look now at Greek banks on a matrix versus other European peers, investors see a picture which is actually very comparable in terms of ROE, in terms of growth, in terms of capital. So there are differences, but it's, I would say, Greek banks have come back into the peer group, which was not the case before. And the only caveat on this matrix is cost of risk, which has improved, but is not yet in terms of NPL ratio at a level which is the most comparable with that peer group. Now, of course, for investors, one of the most important factors is dividend, and that's where indeed this is not yet happening. And for me, the big catalyst in terms of moving from 0.2, 0.3, 0.4 times, 0.5 times, sometimes price to book ratio to get to 0.7, 1 times price to book ratio is this dividend distribution and the sustainability of those distributions. Obviously, another impediment or concern from investors is the lack of liquidity and on the banks in general, and also the lack of coverage. So that will come with time. That will come with further improvement. But clearly, investors need a certain size to invest, a certain research, and that's probably not yet there. But overall, a clear improvement this year in terms of market perception.
Thank you very much. And moving to Mr. Robertson for the last question. You have been living in Greece, I understand, for a couple of months now. You have worked both with Greek banks, but also with European peers over your career. So how do you view as a strategy consultant, the current state of play in Greek banks versus European peers, and where you think they should focus? What should be the priorities in the future? Any convergence play that you see between Greek and European peers that could increase further their value?
Thanks, George, for the question. And I guess given what's been said so far, it's no surprise to say that I also observed that the patient wasn't very healthy a few years ago when I started coming to Greece in the middle of the 2010s with very high NPL ratios, overstaffed banks, and obviously management bandwidth very much taken up by the challenge. But now we see great improvement on the cost side, much more sophisticated operating models, and I think probably the closest to the fit athlete that Lazaros described before, a much more responsive organisation generally thinking very hard about management for value. So it's been a very big change, and much closer to the European standard in a way. And then we can layer on top of that the NIM, the net interest margin in the Greek banking system, has been much more resilient than it has been in the rest of Europe, and obviously the rising rates environment with such a stable and cheap funding base for the banks with the deposit structure they have is a big plus. And the optimism on the macroeconomic scenario that we've heard a lot of today for Greece means that overall, it's a very good picture. So in terms of priorities that can lead to further convergence, in this case, I'd say there probably are still plenty of work for Greek banks to do, but it's more of the same and more good progress to come. One group of work would be sort of completing the transformation and continuing the transformation that's already been started so well, and I expect work there will focus on the IT efficiency that's needed to unblock the changes that are already well started, unlocking more power from data analytics, and probably still a little bit more work to come on cost reduction and people, because the banks have been historically quite overstaffed. But then beyond these things, it's telling that the list of priorities I'd have for the Greek banks are very similar to the list of priorities I'd have for the rest of Europe, which would include things like how to treat the floating rate mortgages in the current interest rate stress. It was pointed out, of course, that this is going to be a very serious stress for the household sector, and Greek banks need to be on the front foot, like banks around the whole of Europe, in terms of protecting their clients and protecting themselves from the impact that can come there. Thinking about keeping deposit rates as low as possible in the rising rate environment, taking advantage of the opportunities in wealth management and payments to increase profitability, and trying to lead and profit from the transition on climate that's coming, particularly in the retail space, where it's much harder to find opportunities to make money out of the climate transition.
So we have come now to the close of this discussion. Ms. McCaul, gentlemen, thank you very much for this very interesting discussion, and a big thank to all of you for following our discussion. Thank you very much.